In this chapter, we are going to look at the statement of cash flows. The main purpose of the statement of cash flows is to report where the company received its cash and where it spent its cash. So we're going to follow cash. Now, all activities within a company are either brought in cash or paid out cash. Now, if the company during the year brought in more cash than it paid out, that difference would be reflected in the cash account. The cash account from the beginning of the year to the end of the year will go up by that difference. If, on the other hand, it spent more than it brought in, that same difference between what it spent and what it brought in would be reflected in the cash account. The cash account will go down by that amount. Now, the statement itself is in three parts. The first part are operating activities. That is the income statement. This income statement is a statement of operations. So the net income is the net of revenue minus expenses. But we need to adjust that because some expenses did not involve the paying out of cash. We also look at the current assets, the inventory and the accounts receivable. And the change in those assets would reflect the use of cash or a source of cash. Same with current liabilities. The second category of activities are investing activities. And here we look at the plant assets, the equipment. Did we buy more equipment or did we sell equipment? If we bought, that was cash out. If we sold, it would be cash in. And thirdly, financing activities. Did I borrow money, which meant more cash coming in, or did I repay the loans? Those are the questions that we ask when we look at the cash flow statement. Flows from the operating activities. Cash flows from operating activities show the net amount of cash received or dispersed during a given period on the income statement. So adjustments to net income for changes in the current assets and changes in the current liabilities, as well as those items on the income statement that did not affect cash, such as depreciation. Now, taking a look at an income statement, here we have sales revenue. Well, obviously, sales revenue represents cash coming in, those kind of activities. Now, there's sales returns and sales discounts, so that was cash we didn't quite receive. So we look at the net cash. That's cash in. Cost of goods sold is cash out, and therefore the expenses are cash out. We would say net income from operations, $30,000. That would be, and it's positive, that revenue exceeded expenses, cash in exceeded cash out. But oh, wait a minute. When I came up with this $114,000 in expenses, there was one here, $8,000 for depreciation. Now, we don't pay for depreciation. Recall, when we determine depreciation, we make an adjusting entry. Depreciation expense, debit, and credit accumulated depreciation. There is no cash exchange. So actually, this would not be 114, it would be 106. If I'm talking cash, if I subtract this, so the amount of net cash profit, 114, minus cash out, 106, would mean that the actual cash I have from operations is $38,000. Now we're going to look at a couple of demonstrations of determining the cash from operations. A company's net income is basically the cash from operations. That is cash in, revenue, and cash out, expenses. But it needs to be adjusted by the current assets. Those current assets of inventory and accounts receivable are investments the company makes in support of operations. They can offset that investment a bit by stretching their accounts payable. So we're going to look at the first problem. The net income, they say, is $200,000. So that's cash from operations. No mention about depreciation here, but they said the inventory increased from $76,500, and on December 31st at the end of the year is $94,500. So that's an increase of $18,000. That's an investment in inventory, so that's a drain on cash. So it's negative $18,000. On the other hand, the liability accounts payable for merchandise purchases went from $57,000 to $68,000. So that is an increase in liabilities of $11,000. And that liability indicates goods and services that were provided to us to help earn our net income, but we haven't paid for it yet. So therefore, it's a little bit of free cash for a time being. And we add that back, 11,000. So therefore, the cash from operations here would be 193,000. In the second case, the operating expenses and taxes, including 80% of depreciation of a company for a given year, were 600,000. Net income was 350. Okay. But to get to that 350, we deducted 80,000 in depreciation, so we add that back. So therefore, we adjust the net income statement for cash, which is 430,000. And then we look at the prepaid insurance decrease, so that's an additional amount of cash, 4,000. And wages payable increase from 22 to 36, and that's again additional amount of cash. So therefore, the total amount of cash from operations here, $448,000. Calculating the cash from operations is the most difficult part of putting together the statement of cash flows. The other two categories are fairly straightforward and easy. Investing activities, those are capital expenditures. Did I buy new machinery? Well, that used cash or equipment. Did I buy trucks or did I sell? That meant a decrease in cash. And financing activities, did I increase my long-term debt? Did I increase my common stock, capital stock? Did I pay dividends? Those questions are answered in those two sections. Now we're going to put all three together and do one problem. Okay, let's look at an example here. Bordeaux Company, comparative balance sheets, December 31st, 2011-2012. So the end of 2011 is the beginning of 2012. And you can see that at the beginning of the year they had 20,000, at the end of the year they had 35. So therefore cash increased by 15,000. So we're going to have to show why it increased by 15,000. That means that those transactions which were a source of cash to the company exceeded those transactions which were a use of cash to the company by 15,000. Now, before we begin here, there's a mistake here. You got to make this 18,000. All right. Now, from operations, you can see we earned 32,000. But they tell us here that to get down to that 32,000 in profit, they deducted 17,500 in depreciation. So we must add that back. So that's a major source of funds from operations. Now, accounts receivable and inventory support operations. These are investments the company makes in support of operations. Now, what did they do? Did they increase their investment or decrease it? Well, you can see that accounts receivable increased by 6,000. So that is a use of cash, and we bracket it. Inventory also increased by 8,000. Again, a use of cash, and we bracket that. Accounts payable, on the other hand, increased, but that means that represents goods or services that were provided to us for which we haven't paid. So that's basically looked at as a source of cash, and in this case, it's 4,000. So we leave it unbracketed. Income tax payable, well, that went down 1,000. The only way it could go down is that we paid it off, so it's a use of cash. So that's from operations. Then you can see that there was equipment purchases or sales. We reduced our equipment by 18,000, and that is investment. And then we look at down here, which is financing. Bonds payable, they were 33,000. They went down 17, so that's 16,000, and that's a use of cash. And common stock was 14 and went up to 18. That's a source of cash of 4,000. Now we put it all together in the cash flow statement. The cash flow from operations. Then we have cash flow from operating activities, 32,000. Add back depreciation expense, increase in accounts payable. Those are both sources of cash. The decrease income tax payable is a use in cash. Same with if I increase my inventory, and my accounts receivable. So the net effect now is that cash from operations is $38,500. Next, we look at the change in the long-term assets and the change in the financing. So now I record the cash from operations was $38,500. When I look at the long-term assets, they were a cash investing. We sold equipment, so the long-term assets went down $8,500, and that's a source of cash. We also, when we looked at financing, we issued stock for $4,000. We redeemed some bonds, so that took cash, and we paid dividends. So therefore, the sale of equipment is cash in, and the net cash used for financing activities was a cash out of $32,000. So when I look at the net increase here, $38,500 plus $8,500 minus $32,000, I get a change in cash of $15,000. Now, my balance at the beginning of the period was $20,000, and at the end of the period is $35,000. So you see, I've explained why the cash increased by $15,000, and that's how we put together a statement of cash flow.